It's been a pretty rough go of it for dividend stocks over the past several years. In fact, really ever since the Fed began hiking interest rates in 2022, dividend stocks, especially sectors like REITs, have really lagged. And that's because, for example, REITs are very interest rate sensitive, and really income stocks in general are, because they're an income generators. And so you compare them to bond yields, and when bond yields rise, the market expects higher yields from dividend stocks, which pushes down the stock price. And especially the laggard, not just the weakness of the performance of the sector, but it's really lagged behind the broader market beginning in 2023, because that's when ChatGPT went mainstream and the AI boom really took off. NVIDIA gave some really amazing guidance, and that just started this rush of capital, rush of excitement for AI stocks. And so that's left dividend stocks largely in the dust. In fact, now many are giving up on the Schwab US Dividend Equity ETF, viewing it as a perennial loser. Whenever, I've made a few videos about it on here, and I get a lot of hate comments towards SCHD. I see that on Seeking Alpha, where I write articles as well. And to be clear, I don't own SCHD. I own my own individual stocks. I've almost doubled the annualized rate of return of SCHD over time with my portfolio, so I get it. But if you look at SCHD's track record, it's one of the best dividend growth engines out there. It has one of the highest yields among dividend growth ETFs. It's got a very low expense ratio. It's got some high quality holdings. So I like SCHD. I think it's great for passive investors who just want to pursue the dividend growth. And I think that moving forward, SCHD and really the dividend universe as a whole is in position to deliver some really exceptional outperformance relative to the S&P 500. And as a result, I think on a relative basis, that being relative to the S&P 500, right now is frankly a generational opportunity to invest in dividend stocks and really outperform. And I think that's because of four major factors, four major tailwinds that I'm going to talk about in today's video. Before I get into these tailwinds though, if you like dividend content like today, which is more of kind of a big picture, and I'm going to give you some individual picks that I like a lot as well at the end of the video, or if you like individual deep dive analysis into dividend stocks or ETFs or CEFs, or if you like to learn about my investing philosophy or even some macro analysis, subscribe to this channel. I think you're going to get a lot of value from it and mean a lot to me as well. Thank you so much. All right, so what are these tailwinds? Well, the first big one is really this idea that the Fed is now pivoting to rate cuts. So if the Fed raising rates from 2022 to onward was a headwind for a lot of dividend stocks, then the logic goes that the Fed cutting rates is going to be a tailwind. Now, I want to put a nuance on that. I've discussed this in a previous video as well, that there's no guarantee, right? Because when the Fed cuts rates, that's just affecting the short end of the curve. That's just short-term interest rates that they impact. They don't impact the long-term. And there are long-term interest rate factors that are actually could push rates higher, at least keep them higher. For example, inflation is still somewhat sticky. It's still in the high, 2 point something or low 3 point something when the Fed's target is supposedly 2%. So they've got a lot of work to do there yet. And so if that remains in that range, and if tariffs flow through even more and to push that higher, that's going to make it harder and harder for long-term interest rates to come down. Additionally, the US government has huge budget deficits, and that means that they're having to borrow a lot of money. And that demand for money in the bond market is really putting a lot, throwing the supply-demand balance out of whack. And to add complications to that, central banks are increasingly moving away from dollars as a store of value and instead moving towards gold. And that's why you've seen the gold price skyrocket so much in recent years. And that's putting additional pressure on the bond market, because instead of buying treasury bonds to be their store of value, they're buying gold. And so with fewer buyers and more supply of bonds because of the growing budget deficit, that creates an imbalance, which pushes up interest rates to be able to attract enough investors to therefore meet the demand by the federal government for creditors. So those are some big factors that are going to have to be overcome to really see long-term interest rates move lower. But the logic does go that if short-term interest rates move lower, that creates room for long-term rates to come lower, because typically when the longer term you put your money away for, the higher the interest rate you're going to get, because that's the time preference. Market has to give you more to incentivize you to reduce your liquidity and lock up your capital for longer periods of time. Plus there's greater inflation risk, et cetera, over those longer periods of time. And previously, really until recently, and even still today, it's pretty narrow spread. Short-term interest rates have been materially higher than long-term interest rates because the Fed hiked up interest rates so aggressively, and the long-term was still factoring in that, hey, they expect inflation to be transitory. They expect the Fed's going to eventually pivot to cuts. And so that was kind of held that way. But the longer that the short-term interest rates have been held higher, the longer inflation stayed higher, the more there's been upward pressure on the long end of the curve. And now that they're finally bringing interest rates lower in the short end of the curve, that does increasingly create room for there to be that satisfactory spread between short and long-term rates, such that the long-term interest rates at least hopefully won't rise too much, and they may even come down some. And so if that happens, That could be a big tailwind for dividend stocks. Okay, what's another big tailwind here? Well, it's the AI boom. Now, you may think, okay, well, the AI boom, isn't that what caused people to dump dividend stocks in favor of the big tech stocks or even the speculative growth plays like Palantir, et cetera? Yes, but you got to keep in mind that now, based on numerous valuation metrics, the broader market is heavily overvalued, and that heavy overvaluation is being spearheaded by these mega cap tech and AI plays like Palantir, for example, is way overvalued by any sane valuation metric. It's just priced like it's going to grow at an incredibly high rate, faster than it's growing today, decades into the future. And so it just doesn't make sense in my view from a risk-reward standpoint. But I digress. That valuation disconnect, though, means that the market is pricing in all these AI boom benefits for these big AI players. Meanwhile, it's not pricing anything in for the dividend stocks. Yet I expect dividend stocks to eventually benefit. You have a lot of big companies that pay good dividends, that have huge operations. They've got vast quantities of proprietary corporate data that they can tap into to create superior machine learning models and basically AI applications. They have greater scale. They can invest in robotics and other automations. For example, United Parcel Services, UPS, they're doing that right now. There are many drug companies that could do that to really enhance their R&D. Even some of the big consumer products companies like Procter Gamble, Coca-Cola, PepsiCo, they all should benefit from that. Even tobacco companies like Altria should benefit from it. I could go on and on. These companies all are positioned to benefit from the AI boom because of the efficiencies it's going to provide. It's going to enable them to further leverage their size and scale and data advantages over smaller competitors, further strengthen their moats. And so all that, I don't think is really being priced into many of these companies. And so that as those user and applications start to advance, as agentic AI, as robotics advance, you're going to see that flow through to the bottom line of these companies, and they're going to be able to see their profits go up, which should cause their valuation multiples to increase as well, which should provide a double propellant to their stock prices and even their dividend payouts growing faster. Whereas, for the big mega cap companies, a lot of that's already priced in. And so I see a big opportunity for that outperformance to shift sectors. Additionally, AI should be highly deflationary. It should finally help to conquer the inflation problem, which should cause long-term interest rates eventually to come down, which, should help REITs and other yield-focused instruments like that to do better as well. So that's another big tailwind. What's a third tailwind? Well, there are several others that I could mention, but I think the biggest one is the re-industrialization of the United States. And that's coming from several angles here. We've got, a lot of foreign companies and countries like Japan, South Korea, Europe, who in their trade agreements with the U.S. have agreed to pour hundreds of billions of dollars into the U.S. across strategic industries to help boost the economy. That should be a big boon to a lot of dividend companies. You've got mega corporations like Apple, Nvidia, and others saying they're going to be investing heavily in the United States as well. That's all going to create demand for industrial real estate, residential real estate, energy galore because of the reindustrialization. It's going to cause a lot of energy and infrastructure demand. You've got the AI boom going on at the same time. That's going to create a lot of demand for data centers and related infrastructure. And so there's a lot coming into the United States for this reindustrialization that should cause the economy to pick up and should directly benefit a lot of real world businesses, and a lot of real world businesses pay out dividends. Finally, there's the regulatory and tax advantages that come with the Trump administration's policies, especially the One Big Beautiful Bill. Now, this is not a political video. I would say that I agree that Trump has made a lot of mistakes. Some of his policies are not good, but I think an objective, observation of the One Big Beautiful Bill, at least in the short term, it is going to be a benefit to the economy with reduced regulations, with reduced taxes on corporations. The tariffs, yes, those are a headwind of some degree, but evidence is showing a lot of that's being eaten even by the foreign countries and the foreign exporters. And, it's being eaten by some of the companies too domestically. But so far, it hasn't really made a huge dent in the economy, either in terms of inflation or in profits. And so, yes, there's going to be some headwind there, but I think it's more than offset by the One Big Beautiful Bill Act with the regulations and the tax advantages that brings to the table. And so that's going to further incentivize economic growth. It's going to further help middle market businesses that, for example, BDCs lend to. A lot of REITs have them as their tenants. And so that's going to help the dividend sector quite a bit, boost consumer demand, higher wages for people to take home pay because of no tax on tips, no tax on overtime, reduced tax on Social Security. All that's going to benefit consumer demand as well. And so those are all tailwinds that I think should boost dividend stocks in an outsized manner relative to the rest of the market, especially when you consider the valuation disconnect. And so where do I see especially attractive opportunities today? Well, again, as I mentioned, I think SCHD is actually not a bad play for a passive investor in the current environment because it's going to benefit from energy demand, from the reindustrialization and AI boom because it's heavy into energy, has a lot of consumer goods, industrials, healthcare, et cetera. Those should all benefit a lot from the various policies that the administration is pursuing, as well as the AI boom. Those should all be really good. And it's undervalued, I think, relative, again, to the broader market. I think certain areas of the REIT sector are good, especially if they have better inflation protection and they have really strong balance sheets. They can hold out against the higher for longer interest rate environment, but still benefit from rates falling if they do. Durable and defensive, stagflation resistant. I think Sunbelt residential real estate is attractive because the AI boom and the reindustrialization of America to be concentrated on business-friendly environments. So mid-America apartment communities is a cool idea there. I like energy infrastructure a lot. I've talked about it a lot in my videos. Midstream is one of my favorite places to be. There are some AI infrastructure plays that are still undervalued, like Blue Owl Capital, Brookfield Infrastructure Partners, Brookfield Renewable Partners, for example. Those are really attractive plays right now. And again, so yeah, just anywhere in the dividend space, diversification, or especially in certain sectors like strategic real estate, strategic infrastructure, energy. And if you know what you're doing and you can understand pipelines pretty well, the biotech company, while they're facing headwinds today because of some of the Trump administration's policies, if you can buy them on the cheap over the long term, those could be good plays because of AI tailwinds coming their way. So hopefully this was helpful for you, thought-provoking. If it was, give the video a like, subscribe for more content like this, hit the bell for notifications, and let me know in the comments below what you think and where you're finding attractive dividend investing opportunities today. Thank you so much. See you next time.